Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Robert Kaplan, of course, the former president of the Dallas Fed. There's 5 people for chairman. I would suggest Kaplan could be 6th chairman. Have you spoken to Mr. Bessent about this position? You are more than qualified.
I am busy in my job at Goldman Sachs, and very happily so.
See the terseness there?
Yeah.
It's like when you talk to me, why don't you save the interviewing? A question about the Fed.
All right, so we have 5 unofficial nominees out there, according to Treasury Secretary Scott Bessent, and we all kind of expect that whoever is chosen will, pretty much stick to President Trump's dovish stance, lighter regulation, all of that. What about the coordination between the Federal Reserve and the U.S. Treasury? What might that look like?
So let me just when it comes to monetary policy, actually, the administration will pick the chair, but the chair, once he's confirmed and in the job, is going to have to do what he believes and the committee believes is the right thing to do, without regard, in my opinion, to political influence or political considerations. The way they'll coordinate with the administration on regulatory policy, for sure, there's enormous coordination. There has been for a long time. And so they'll coordinate that way. I think you will see in the future more coordination on the balance sheet. That's a possibility. Fed has a $6.25 trillion portfolio in treasuries and mortgage-backed securities. To the extent they coordinated more with the Treasury on duration and the composition, that would be a change, but that wouldn't surprise me.
How much coordination is there right now or previous to President Trump?
I think there's, on regulatory side, significant. On the balance sheet, I think other than being aware of issuance schedule, I think less so. I think that's something that could get revisited.
I want you to talk. We're going to have Robert Kaplan back with us for a lengthy conversation here at the top of the hour. The distance from Dallas to Oklahoma is 206 miles, and they are planning out an urbanization or businessization up to the Oklahoma border. I don't think Americans understand the scope and scale of a Texas boom.
Well, so I was just in Oklahoma City, and I go there regularly. It's fantastic companies located in Oklahoma City. Obviously, there is a significant trend of migration of people and firms to Texas. We're outgrowing the country. And so I think that's why you're going to continue to see people and companies migrating to the state and to the region.
I mean, it just doesn't end, does it? You want to get in here, please?
No.
Well, I mean, we see banks, for instance, trying to buy each other. Huntington Bank yesterday just purchasing or announcing it's going to purchase Cadence, right? And part of that is because it wants more access to the Texas market. And that seems to be a driver for a lot of the regional bank consolidation. This idea that they want to have that presence in Texas, northern Texas to be particular, because that Dallas region and northwards is where most of the growth is happening.
Yes, and there is enormous growth. Cadence is headquartered in Houston. 2
headquarters, right? One in Houston, one in Tupelo, Mississippi.
That's right. And then Veritex, which they also bought, is in Dallas. And so, yeah, there is, and we see it every day. Companies are migrating there. People are coming there. It's a central location. There's no state tax. It's very welcoming to business. And so it's not surprising that banks around the country would be looking for opportunities to be bigger in Texas.
Let's come back with Robert Kaplan, a really stellar term as president of the Dallas Fed and all his work at Harvard over the years. I want to talk to him about business enterprise. The great inflation, Mr. Kaplan, it's out of control.
So I taught at the business school, and at the business school there is a curve. And the highest grade the highest grade I ever gave is a high pass. High pass, low pass, and it's done on the curve.
Stop. The divide here between economics. Jason Furman's over there with real students doing real work, and there's a whole bunch of other degrees where everybody gets an A. That shatters the school.
Well, I can't. I am no expert on it, so I can't speak to it.
Tom Keene and Scarlet Fu with you this morning across the nation for America and around the world. Our new digital effort, YouTube. Subscribe to Bloomberg Podcast, Scarlet Fu with Robert Kaplan of Goldman Sachs.
Vice Chairman of Goldman Sachs, and of course, the former president of the Dallas Fed, joining us as the Federal Reserve begins day one of their deliberations on interest rate policy. We'll get the decision tomorrow at 2 p.m. Rob, what is likely to be the surprise from this meeting?
I don't know they're going to be surprises. They're going to cut tomorrow. They're going to announce, I would guess, they're going to end the quantitative tightening. Those aren't surprises. I think the only possible surprise is I think Jay Powell, I believe, should leave the door open to cutting in December. The markets are pricing in that they're going to cut in December, but he's going to want to leave some optionality just in case. They're getting closer to neutral. Inflation is still running 75, 100 basis points above target. So it might be taken some as a little bit more independent, wanting optionality, although I don't think they should be surprised by that.
It's great to have you in here. The only one I can think of as equivalent is Richard Fisher, the modern age folks. Robert Kaplan's understanding of business process, how to succeed, and also how to enjoy failure is second to none nationwide. Mark Wynn and Lillian Deer, the Dallas Fed this year. Advances in AI will boost productivity. For who, Mr. Kaplan?
Yeah, so ideally, ultimately for the whole economy. It for sure in the near term over the next few years for business, the trick will be to get those gains in the whole economy. The workers that lose their jobs will have to get retrained and redeployed into other productive jobs. And that's what we haven't been great at in the United States.
I was going to say good morning to North Carolina and the Deep South as clothing manufacturing disappeared in the last part of the century. All of us have been humbled by our elders' failures at retraining. We're not Germany, are we?
No, and the problem is this can't be done nationally. It has to be done locally. Worker mobility. If I lose my job in Texas, I'm not going to move 1,000 miles to get a new job. Ideally, in a 100-mile radius, I can go to a junior college, get retrained, and find another job. And that's why it's so hard.
So this is the local government's responsibility or the company's responsibilities, industry's responsibility?
A little bit of increasingly both. I think companies are realizing if you want a vibrant community and state, you need to provide the faculty and the money for retraining, but you need a vibrant, high schools are doing it, P-Tech, junior colleges are doing it. Colleges so far are not doing it. Maybe that will change, but it's going to take private business and these educational institutions. And then you got to make people aware that these jobs are available.
Is this CapEx that shareholders will reward?
It is investment, not that huge investment that makes a vibrant city, state, and national economy, improves U.S. competitiveness to get these people redeployed. And remember, my workforce growth this year is down to, I don't know if it's zero, it's close to zero, very low. We need to make use of every able-bodied worker and help them get in and stay in the workforce. We got to get better at this.
So within Luddite America, and of course Kaplan folks comes off the prairie of Kansas, so he's got a whole different view from 3 zip codes in the East Coast. And the answer, Robert Kaplan, of Kansas is we have failed and failed and failed at this within our Lockean individualistic. We're not Germany. We're not socialized. We're not going to do that. This is where you shine. What is the political catalyst to change our individualistic behavior to get people that do want to be retrained, or even those that don't want to be retrained, into the AI process?
Yeah, and by the way, this is round 2 of this. Globalization led to this, and we struggled to redeploy people, and there was a political backlash.
Well, Stiglitz said we're discontented. Are we going to redux it?
So if you don't do this better on AI and technology-enabled disruption, you're going to get, again, political backlash. And listen, there's 85 million workers in this country. that make 50, 55 grand a year or less. They've lost 25% purchasing power. Their jobs, depending on what they do, are somewhat threatened. And they are voting accordingly.
Okay, so someone needs to step up. Have we seen any good examples of this elsewhere around the world? Did anyone figure it out last time around during the wave of globalization?
Germany is better at it. I would say there are bright spots in the United States. Dade Community College in Florida, Dallas County Community College in Texas. It's not that there aren't, in the Permian Basin, there's a fantastic skills retraining effort. It's not that we don't do it well in the United States, but it's uneven.
We don't do it at scale.
Why can't we generate Trump could be elected to a fourth term if he generates a federal program that diffuses down to the state level.
So I would love it if we had more national discussion about this. And I love college. I taught in a college. However, instead of giving money for more kids to go to college who aren't graduating even in 6 years, channeling more of the money into skills training and encouraging kids to go for skills training first, I think we would have a better economy and a more prosperous population.
Yeah, that makes sense. And we've been talking about this for a long time, since the great financial crisis. And it feels like efforts get stalled along the way because there's fires to put out constantly.
At the local level, you'll see there's been great progress made. Okay, it just there isn't a lot of discussion about it from what I can tell at the national level, and it's uneven again through the United States. And you also got to remember, 45 states populations are flat to down. So state like Texas, state like Florida is good at it. We've got the money to fund it. We've got the migration of people and firms coming. I think we've got to make it more prevalent nationwide.
You'll recall with globalization in the Clinton administration, there was the promise for retraining, but then that money went to lower the deficit.
Yeah, and so there's a number of problems on retraining. One, and there's either lack of facilities, I can't do it easily in my high school, and also some of the jobs are not yet aspirational. People don't realize a window installer can make $150,000 a year, and the people who are looking for jobs may not want the jobs that are open. That matching issue is going to have to get addressed also.
For you across the nation this morning, Robert Kaplan with us. Too many things to talk about. A work at Harvard Business School, his work with Goldman Sachs now as vice chairman, and of course his public service at the Dallas Fed as well. We're on YouTube. It's our new digital distribution. Subscribe to Bloomberg Podcast. Scarlet Fu in for Paul Sweeney today. Mr. Kaplan, one of the things I do want to talk about is what's out there, and I'm not talking about football coaches at Penn State or whatever. There's a whole feeling of an unfair distribution and compensation. I would suggest we started with a wonderful idea that if executives were incentivized with equity, they would work harder, be smarter. And what it turned into was a ratio of football coach compensation to English faculty and a ratio of CEO compensation to everybody else out there that has led us to America's. How do we amend that besides a trite answer to pull up the incomes of everybody else, which no one agrees is happening? How do we amend what we stumbled into?
Yeah, so I'll speak for how I'm spending my time personally, philanthropically. I think many of us are involved in trying to get a higher percentage of populations in our cities and states to get a secondary degree, get into a better job that pays a middle-class wage. I still think that the education still is the vehicle, I think, to improve income and income distribution. I won't comment on CEO pay and board decisions on that, but I'm a big proponent of all of us investing our time, money, philanthropically and otherwise, and our time to improve educational attainment.
Do the schools get that right now? I mean, they're just trying to keep the doors open and make sure that they don't lose government funding.
Schools absolutely get that. Let me tell you, the demographics are such, you're going to see a number of colleges. The number of colleges in this country is going to decline. You know, the demographics, there's less demand
for the
industry.
Cliff.
That's right. Yeah. So I'm seeing high schools convert to P-Tech, junior colleges doing it. I think you may see some colleges saying, we need to open a new wing channel to have skills training as an option for our students, particularly those who aren't going to graduate even in 6 years.
Right. I was with Chris Waller the other day, and the question that sort of stopped the conversation was my idea that we can't aggregate a la Alan Meltzer at Carnegie Mellon, and that the fact is John Edwards was right. We have two Americas. Do we have two R-stars out there? And whether it's Kaplan, can we get an event going here? Robert Kaplan for Fed chairman. Let's work on that while we're here.
I think that won't
Chairman
go very
Kaplan,
far. Yeah, I don't think so.
Can we get? How do we manage two R-stars of one policy for an America flat on our back and another deciding where to spend the wealth effect right now? What do we do with two R-stars?
So there's the Fed funds rate, and we've sort of gotten used to over the last 10 or 15 years think that the monetary policy is the be all end all. It's not.
Thank you.
There's all these structures. There's tax policy. There's education policy. There's immigration policy. There's what we do on education, health. There's a whole bunch of structural issues, and it's going to take all of these things to address these issues.
It's just like it's a job interview for chairman. I mean,
that we're conducting here surveillance.
Scarlet, ask another question.
There's been
please.
a lot of talk that maybe the Federal Reserve should not target the Fed funds rate as their main lever for monetary policy, to be more targeted in their approach.
Yeah, I wouldn't go over. So here's what that's about. The thought is maybe they should target something that's tradable. SOFR, the overnight, the fixed rate, collateralized rate, or the tri-party. These are wonky terms, tri-party, repo. But those are both in the midpoint of the Fed funds rate. This is a discussion that's going to happen over the next year, but not necessarily an urgent one today. We're in the but people are saying pick a tradable rate, not one that's artificially set.
I hear what you're saying about how it's not urgent at the moment, but the argument is now's the time to do it because it's not urgent. By the time it becomes urgent, it'll be too late.
Well, we've been discussing it at the Fed. I can tell you when I was there, 5-6 years ago, we were discussing the same thing. I don't think it's going to blow up into a crisis. I think the next Fed chair I think it'll be appropriate. Wait for the next Fed chair. Fed just did a policy review. They didn't touch this. They'll get to it, and it'll be one of several things that probably should get looked at.
So it's like 8th on the to-do list right now?
It's not number one on the to-do list right now, but it's a good subject. I'm glad it was raised. In fact, Lori Logan of the Dallas Fed raised it. I think that's great. She did. We've been discussing it for years, and we should come back to it.
This question just came in. Ask Robert Kaplan what he would do with the Dallas Cowboys. I mean, has the Dallas Fed ever done a study of how the richest franchise, in America can fail for so long?
Yeah, and I'll make a prediction. I don't think you're going to see a study from the Dallas Fed on that. No, we have no expertise. I have no expertise on that, other than how to work the TV clicker.
Okay, Robert Kaplan, thank you. This has been a great conversation. Thank you so much for the generous time. I really can't emphasize enough the business process that's out there. And as John Tucker mentioned, the AI struggle here for the rest of America will be something. It'll be a huge theme for us, I'm sure, into next year as well. Robert Kaplan is with Goldman Sachs. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Ed Yardeni has delivered a rational plan to participate in the market, and we get an important update with him this morning. Of course, of C.J. Lawrence years ago, definitive at Yardeni Research. Ed, in your morning memo, an incredibly valuable Yardeni Research, what is the view forward at Dow 48,000?
Well, I think the bull market continues here. We've still got some good news ahead. Some of it's been discounted, of course, but the Fed is expected to lower the Fed funds rate 2 more times this year, so that would get us down to 3.5%. By the way, I don't think that the economy really needs it, so a lot of this stimulus is probably going to feed the bull market. And I'm looking for the S&P 500 to get to 7,000 by the end of the year or by the end of the week. I mean, things are moving pretty quickly here. And then 7,700 by the end of next year. So I'd say, we probably over the rest of the year have a 4% increase ahead of us in the market. That's been the average over the past 10 years for November and December.
And you run a real sophisticated racket here of economics into the equity market. I want you to speak now to people who bought into the gloom view, not the people with the gloom view, but our listeners and viewers that bought into caution, bought into worry. What do you say to them about this continued American financial experiment?
Well, the experiment has been quite a success for quite a long time. I think people still have some pessimism on a historical basis. As a matter of fact, the book was just written about 1929 by Andrew Sorkin, and it's a very good book, but it's kind of consistent with the pessimism that's still out there. I, on the other hand, have been talking about the roaring 2020s since 2020, and that's worked out really, really well. However, I constantly get reminded that if I'm making an analogy to the 1920s ended very badly, and I kind of counter that by saying, well, it was the Smoot-Hawley tariff that really caused the crash and the depression that we had in the 1930s. And right now, the economy is passing that stress test remarkably well. We've had a lot of tariffs imposed here, and the U.S. economy is still doing just fine. Well, the economy has proven remarkably resilient since the pandemic. Tom, remember, after the pandemic hit us, we immediately put on the lockdowns. They lasted 2 months.
Right.
We then had a very sharp recovery, but then we had the supply side disruptions, the inflation, the Fed tightening, and look, the economy's at an all-time record high in real GDP, and so is the stock market.
Across the nation, we start strong this morning. Ed Yardeni with us. We say good morning across all of our distant radio and audio distribution. On YouTube, subscribe to Bloomberg Podcast. They just briefed me, Scarlet. Ed Yardeni's ginormous in India. I had no idea.
Ed Yardeni's ginormous everywhere.
Huge Pacific Rim and over to India audience. Scarlet Fu with Ed Yardeni.
Dr. Ed, with all the liquidity sloshing around and this unbridled optimism, how much do seasonal and technical factors matter this time around? There's data that shows the NASDAQ 100 has averaged an 8.5% gain from October 20th through year end. The S&P returns about 4.2% on average since 1985. There's a lot of history behind this rally continuing.
Well, it's conceivable we've already had our Santa Claus rally. Sometimes the Santa Claus rally is timed as being somewhere between Thanksgiving and Christmas Eve. Sometimes it's extended to New Year's Eve. But I just look at November and December. I look at it by months. And the average increase over the past 10 years in the S&P 500 is added an additional 4 percentage points to the return of the market. The market right now is up a little over 15%. Slap on another 4%, and you get something close to 20%, which will be the third year in a row of remarkable double-digit gains, and would get us to 7,000, maybe even a bit over 7,000 on the S&P 500.
John Tucker, did you listen to that question from Scarlet Fu? I mean, have we ever had anyone in the studio this prepared? It's 7:16 in the morning.
I know how to read. That's my strength.
You can't do that again. Ask another question and keep it as dumb as mine.
All right. Dr. Ed, we have earnings coming up. 5 of the Mag 7 names will be reporting. People are looking for catalysts to continue to drive these Mag 7 names higher.
Right.
Do you think we're going to get it, or is it going to? Is the stuff that drove us in the past, CapEx, going to continue to be the drivers this time around?
Well, there's a lot of nervousness about whether all this CapEx is going to be profitable for the so-called hyperscalers. But if anybody is in a position to know whether it makes sense to carry on this kind of capital spending, it would be these companies that are very much involved in cloud computing and can see the extent to which the capacity of their servers is being stressed, and they need to scramble to increase that capacity. Look, I think we all just need to look at our own lives. I can't speak for everyone, but I'll tell you, I'm using AI all the time. I use it as a research assistant. It's not the smartest research assistant, so I have to double check it, but I do use it all the time.
I agree with that, Ed. It's absolutely, folks, full disclosure, I'm using Perplexity. Thank you, Tom Secunda, founder of Bloomberg, who got me onto that. And my life has changed because of it. This is Gordon and Saunders. It's a great band. It's Charles Schwab, Ed Yardeni, Liz Ann Saunders just publishes earnings reports are painting a picture of an economy that's bending a little under government and monetary policy uncertainty. As we bend under policy uncertainty, what's it look like on the far side?
I think it looks better, right? I mean, presumably this government shutdown ends, though, I don't know, it's kind of, the market certainly hasn't been upset about the shutdown, but this too shall pass pretty rapidly, I think. There's some real stresses now occurring within the Democratic Party to just sign a simple deal and move on. So I think that issue will dissipate. The markets and the economy have learned to live with the what I call the Trump tariff turmoil, which I think we're going to get more of it, right? Because in November, the Supreme Court is going to consider whether the tariffs are constitutional or not. There's a good chance that they will be deemed unconstitutional, which I think explains why Trump is racing to get deals, because even if it's unconstitutional and he's got a whole bunch of deals with key countries, those deals will hold.
And we see that with the president still speaking in Tokyo. We're monitoring that with Josh Wingrove and Tyler Kendall. Ed, one final question. The beast on the couch seems numb. I mean, for those of you on radio, Ed's got the stylish office with 4,000 books, and that beast on the couch, is that because does the beast have a 401k that's killing it right now?
Oh, come on, Tom. You've met Max before. Max just loves your show, and it's very soothing.
But he is sleeping, by the way.
Well, he's listening, you know.
That's why he's sleeping.
Ed Yardeni, thank you so much. Congratulations on continued leadership in this bull market. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Drew Matus for too short a visit now. We had to get into Microsoft view with Caroline Hyde as well. Drew, thank you for bringing us back to reality, which is many parents nationwide are looking at their kids, 18, 22, 24, and going, what's the future? You're expert at this. You do this every day at MetLife. What's the future for the young kids right now?
Well, I mean, parents are worried about it. And, you know, unfortunately, it's the same kids who got hit by COVID, and now they're graduating, and all the CEOs are saying, we don't need to hire because of AI. And as a parent of one of those kids, you know, it's not an encouraging situation. And I think when, you know, people can tolerate a lot, but when they think their kids are going to be worse off, that's when they start to get really aggravated, irritated, and begin to change behaviors. And I think if you want to know what's going to create the downdraft in the economy, it's the upper income consumer deciding that they're going to have to basically pay for their kids for the next 40 years, and they're going to need a little more money to do that, and they're going to save instead of spend.
That's depressing.
Tell us a little bit more about this K-shaped economy and that line at the top. Who does that person look like, the typical person, and how has that changed, and how will that change over the next 10 years?
Well, so, I mean, let's think about the K-shape. There's the K-shape, and then there's kind of, the billionaire class, right? And the billionaire class, they don't even think about buying a car, right? They're not the ones buying the car, right? They're helpers buying the car for them, and someone else is driving it.
Their company is buying the car.
When you talk about the upper income taxpayer, or kind of like the upper middle class person who can decide whether to save or to spend, what the surveys that we're getting now, because we only have survey data from things like the Fed, are telling you is that they're more worried about their jobs. They think that their real incomes are getting worse. And they think that the outlook is not great. And that's not a recipe for a huge amount of spending taking place. So they might have bought a car because they had the means to do so, because they were trying to get ahead of tariffs, and they thought they might need to replace their car in a year or two. But they're not necessarily spending on an accelerated basis on an ongoing basis.
Then, Drew, quickly here for tomorrow's Fed meeting, what is the labor mandate we're going to hear about tomorrow from the Fed?
I mean, my feeling is the Fed has two choices. You can have slow growth with higher inflation, or higher growth with higher inflation, and they're going to choose the latter because it's the least of two evils.
Drew Matus, thank you so much. Too short a visit. We got to do it much longer. Should Drew come in next time? He can come in with a bow tie.
Does he do that?
He has one of the rare coveted merch surveillance bow ties.
I remember those.
Yeah.
That was very like 2012.
Yeah, they were. Yeah.
There's a vintage tied to it.
They come out of fashion and that.
We should do it on Halloween.
Well, we should.
Yeah.
Yeah. What are you going as for Halloween?
I'm not dressing up. That's not my thing.
Yeah. Okay. Drew Matus, thank you so much. He's with MetLife. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Steve Sosnick with us, Chief Strategist at Interactive Brokers, here to look at this moment that we're living in. What is the character of this bull market that you see, and particularly with all the knowledge and transactions that you have at Interactive Brokers?
Good morning, Tom. I think what we're seeing is it's a momentum-driven, almost hype-driven market. I would say, we've all been taught about buy and hold or buy the dip. I mean, this is almost buy and chase. I look at
institutionals as well.
To a certain extent, yes. Although, among our customers, what I see most pronounced is among our more active individual customers going after, I'm going to call them thematic names, like Beyond Meat or Oklo or Rigetti. But everybody's kind of doing it because they have to.
That's not 401k money. That's the speculation of it. What do you observe among people with a long-term 3-year or longer time frame? To me, it's just a wall of money looking for a warm spot.
It's really don't fight the tape is really the mentality. I mean, this is what it's become. And when you have credible people and credible money, monetary policy easing and fiscal policy that can be good for companies, if not necessarily all individuals, that's the way it goes.
I'm depressed again. It's 8:30 and there's no economic news, Scarlet.
I know. You need your daily dose.
It's like we need our dose, our fix, and it's not here.
No economic data, so we don't really have any official read on the job market beyond what we get from private sources. We talk about these headlines where Amazon is losing 14,000 jobs, UPS is getting rid of 34,000 jobs, but sales and profits are beating estimates. So earnings are coming in better than expected. Steve, at what point do the job losses matter more to investors and markets than the preservation of margins?
I think when we get to the point where the Fed would be pushing on a string and really doesn't have the capacity to do anything about it. What the other problem I think we get to is, if you think about a K-shaped economy, we want sort of a nice small K where that inflection point against the y-axis is relatively low. I think we're getting an inverted K where it's higher and higher, and I think there's more nervousness. And if that permeates the economy among, let's say, people who thought their jobs were relatively safe, that's when you get into real problems. And it's not a matter of the Fed cutting rates 25 basis points here and there.
So how are you looking at earnings season? How much confidence do you take from the results that show better than expected once again for the X number straight quarter?
Well, what I've said all along is I think that corporate management it's just as important not only to manage your own business, but it is also to manage your analysts' expectations. So I think that's why you've seen sort of an increasingly steady trend of, it used to be 75% of the companies beat. Now it's like 80 or 85%. It's really about the guidance and the other one I like to watch is cash flow, because you can't really fake cash flows. But I think we're going to find out going ahead this week, because you're getting 40% of the S&P, market cap this week, and where their guidance comes in. But I was looking at options pricing coming into this, and long story short, they're not really pricing in any big expectations of moves.
Steve Sosnick with us with Interactive Brokers. What'd you learn? This is a few years back at the Salomon Brothers trading program, their training program.
Yeah.
What'd you learn there?
I just learned, you learned that there were just little tactics. I mean, one of the things I remember was, don't leave a sink full of dirty dishes, meaning, and clean them when you get them, meaning that don't leave a big stack of phone calls at the end of your day to get rid of everything before you go home. A lot of the discipline about that, just also a lot of discipline about how the markets worked.
Is this market disciplined right now with our new technology, which frankly has been led by Interactive Brokers? I mean, the volume of people playing is overwhelming.
Yeah, I mean, I think that, I'm certainly not going to complain about the democratization of the financial markets. It's been very good for me and my company personally. But I do think that what it tells us is, at some point you lose control of the narrative, because I think it becomes self-fulfilling. I've described this market as Pavlovian. The bell rings and off we go. And you could see it this morning. When the alarm clock rang for people, we went from flat to up 9 basis points. I agree, and some of that was the layoffs and Trump and the rest. But the issue is, what's the character of the exuberance now? The character of the exuberance is that this is just a party that, that this is a party that's going to go on forever. And the question is, are we, put it in baseball terms, are we in the, sixth inning, or in the ninth inning, or are we like last night's game and in the 14th inning? Can I put it like hockey terms? Sure. It's like when the Rangers beat Montreal the other night and you thought it would go on forever.
Yeah, well, that was all because of the third period. Steve, how are you thinking about this administration and its wanting to see we have a buoyant market, a buoyant economy through the midterms? I mean, this baseball game can go into 20 innings if that's the case. Yeah, I mean, I think what shocked everybody in April wasn't so much the tariffs themselves, but it was the tone-deaf response from the administration in response to them. It was originally like, big deal, we're going to do what we're going to do, and it was only after the bond markets got yippy, not my term, that things turned around. And I think there's this confidence that the administration will do what it's going to do in terms of getting the markets righted. The Trump put. But I think that only goes so far. I mean, I think the Fed put, I've always said, is not about stocks. It's about the system. It's a systemic put. And that's something I learned actually at Salomon Brothers when I was there in the crash and saw this being, so I was there in the maternity room, so to speak. Is the Trump put about the 10-year yield or about stocks? I think it's about whatever he wants it to be about that day. I mean, I think crypto probably most definitely, because honestly, he's becoming very rich from crypto. And I think he does not want that party to end. But I think you need them all as an ecosystem. You need a solid bond market to have a solid stock market, and to therefore have the type of speculative environment that enables crypto to do what it does. How closely do you watch things like Bitcoin's share price then? I mean, what's the correlation between crypto and the traditional asset classes? Right now, Bitcoin's sort of, Bitcoin, it's kind of NASDAQ-ish. It does have a reasonable correlation with NDX. It's evolving. I actually spoke at a crypto conference in Stamford last week, and I was surprised. Did they throw things at you? They did not, and I was surprised that I was not the only person there with gray hair. I thought I was going to be like this. I thought I was going to be grandpa in this room, and I was basically like around the median age, which was a little surprising. This has been great. Steve Sosnick, thank you for the update. It's an incredible market. I mean, it's just truly, truly historic. Steve Sosnick, Chief Strategist, Interactive Brokers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.